Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Yep. We're glad you are here with us as we are now into May 2024.
Yes. And I want to talk about a couple things today on the show, Scott. This one came out a couple weeks ago. It's been working itself through the press. It was in our industry press before it then hit the Wall Street Journal and then the local press. But how IRAs will now have to be IRAs, individual retirement accounts that are coming from a 401k, have to be held to a fiduciary standard. We're going to spend a couple minutes on that. And if that doesn't keep you listening, I don't know what will. It's interesting, though. And I don't know actually how I feel about this or how they can actually enforce it. But
I would agree with that, both those statements.
Yes. So we'll talk about that, and we're going to take some calls. If you'd like to join the show, 833-99-WORTH, and we'll get you on the air. We'll schedule time for you to join us to have a nice little chat.
That's a nice chat.
A nice chat.
Well, and it's the market volatility has certainly returned, right?
Yes.
And if we look at the latter part of 2023, the first quarter of 2024, everything looked so rosy. And regardless of what happened, like markets were going up. And then it's like, wait a minute, maybe the Feds aren't going to cut the interest rates 6 times. Maybe they're only going to cut them 3 times. Wait, maybe the Fed's only going to have 1 rate cut. Wait, maybe the Fed's not going to cut rates at all. And then if you look at what happened, the growth of the first quarter, below expectations. What is it, 1.5, 1.6%, the GDP for the first quarter of
and then what's happening in Europe and the Fed completely disconnected on like the global economy. It's like everyone's in it for themselves. They're not coordinating between the U.S. There's oftentimes coordination between the Europe, essentially their
central bank,
and our central bank, and everyone else now is like, we're just going to go our own way. It's a tough environment.
Yeah. And inflation, ticked up a little, is 3.7%, I think, when
yes.
looking at inflation's up, growth's down. That's not a good combination when you've got
inflation's up, growth's down.
Yeah.
Turmoil in the streets. Blocking the Golden Gate Bridge.
Oh man!
Oh,
you read of some of those students. It's funny that there's these elite universities, all these protests, and then you read some of the accounts of what these kids are saying. You're like, how did you make it to that school? Is this our brightest and best? You have no idea what you're talking about.
I don't believe half of those people actually protesting are from the schools.
Well, I remember when I was at college, and my girlfriend's roommate was the organization of some sort of something or other. She was telling me about they were having all the protest meeting in their apartment, and okay, Thursday at 3, we're gonna meet outside Burger King or whatever it was.
We're gonna protest.
Someone says, "What is it we're protesting again?" So she told me the story. I thought it was the funniest. What is it we're protesting again?
I need to read up on this.
I guess my life has been so good. I'm at this university. I'm just hanging out in my apartment in the afternoon. I don't have to work. I got everything paid for.
And everything, like, we're going to protest.
Protest about something.
Anyway, so we're going to talk about the RIAs. And then I want to talk a little bit about the ARC funds from Cathie Woods from 2 perspectives. One is how, when it was doing really, really well, they just kept rolling out new ARC funds after new ARC funds after new ARC funds, which reminded me of Janus funds
back in the 90s.
In the 90s. So we're going to spend a couple minutes on that, and we're going to take
my guess
your
is
call.
most listeners Janus funds in the 90s. I don't even know what you're talking about.
Okay, we'll talk about it. We'll explain it.
All right, let's start off here in Ohio talking with Adam. Adam, you're with Allworth's Money Matters.
Hey, guys. Good to talk to you.
Thank you.
So I'm calling in. I'm hoping to get some help figuring out the best way as far as taxes, I think, to not only plan for retirement, but also hopefully save for my kids' college funds.
Okay.
Always start that. So our situation right now, I have
How
one
old are you?
amazing wife, 2 beautiful children. Sorry, say that again.
Wait,
I've got an amazing wife.
amazing
two
wife
beautiful children.
and 2 beautiful
I'm
children.
extremely handsome.
Okay.
Yeah, I'm not. I mean, I don't have much great stuff to say about myself, but they're pretty great.
Okay. How old are you?
I'm 27.
And
I'm
how
working
old?
as a nurse right now.
A
Sorry, go
nurse.
ahead.
And how old are your beautiful children?
My beautiful children are 3 and almost 2,
Okay.
and we actually have a third on the way right now.
Wow.
Congrats.
Thank you.
And your spouse, does she work outside of the home?
She works as a real estate agent part-time, so she's a Schedule C employee. So
Okay.
I think that kind of muddies the waters a little bit as
Okay.
far as figuring stuff out.
Got it.
So I work as a nurse right now. I take home maybe $100,000 a year or so, which is definitely way more than we need to live off of. So I've been maxing out my Roth IRA kind of each year. Been doing that for about the past 3 years now.
Roth
But with
IRA?
my Roth IRA, yes.
Okay.
But with my wife being a Schedule C employee, I didn't know if it makes sense for us to be maxing out hers versus mine.
How much did she make last year net?
Not very much. Maybe in the 20,000 to 30,000 range.
Okay.
But you haven't put a Roth IRA for her.
No, she actually does not have an IRA at all. She used to be a teacher, so she has a few very small, like educational type retirement funds.
Yeah.
So we've kind
403Bs.
of been letting those sit there.
And do you participate in your employer's 401k?
I do not.
Do they have a match?
So I'm actually working as a travel nurse right now. So I'm
Okay.
working for a different hospital, different company every few months.
Are you employed by
that
the?
makes sense to
Are you
carry
employed by the?
401k and change it over.
Are you employed by the hospital or are you employed by an agency?
I'm employed by an agency to
Okay.
work at the hospital.
All right. Well, there's a good chance the agency has a 401k with a match. It's probably a better chance that they do than they don't, because you stay employed by the agency and they just move you around to the hospitals. Correct?
For the most part, but I also bounce between agencies because depending on what hospitals need, what needs
Okay.
different hospitals have, I might actually have to jump agencies to get better pay.
Regardless.
Depending
Okay.
what hospital
All
I'm
right.
going to.
And how much insurance do you have on yourself?
As far as life insurance,
Yes.
and then maybe that could be the next question I have next time I call in is what kind of health life insurance I should get, because I have zero.
Okay.
No
well,
life insurance
we're
at
not
all
gonna
right now.
we're not gonna talk about the rest of the stuff until you buy some life insurance.
So you think that should be my first step?
Oh,
Yes.
I wouldn't even. I'd hang up the phone, and I would get online, and I would buy $1.5 million a 20-year level term.
Okay.
Look, you've got a 3-year-old. You've got a 3-year-old, a 2-year-old, and one on the way.
Yes.
You are the provider. You, right? Something happens
Yeah.
to you.
Something happens. Your wife doesn't have any. She doesn't have the helper anymore to even keep her real estate business going.
Right? This is completely dependent. And this, by the way, you are a normal 27-year-old.
No, because normal 27-year-olds aren't married with 2.5 kids at this point anymore. That was the norm 25 years
okay.
ago, 40 years
Okay.
ago.
But you're the normal person with a couple kids. Most people just completely go right to the savings. Like, how can I save more? How do I pay less in taxes? And forget about the life insurance. The
Yeah,
life
which
insurance.
I definitely did. I skipped right over it.
Yeah, correct. $1.5 million life insurance, 20-year level term. Start with that. Start with
Okay.
that.
And the reason we're so adamant, like, we've been in this industry long enough. We've sat beside the table of people widowed trying to figure out how do we make the finances stretch because we've got kids at home.
I remember telling a kid that they couldn't go to the college that their father told them that they could go to because there was not enough money. And the mother and the daughter crying in front of me saying, but my dad made this promise. And I
Wow.
said,
Mm-hmm.
that's good. I'm glad your dad made this promise. There is not the resources with these 4 kids for you to all go to college if you go to this one.
Mm-hmm.
Right? Help them write letters for financial aid. an appeal as an alumni because the father had it's everything, right? It's everything. The second thing you should do is actually build up a liquid savings account and a high yield account. How much money do you have in liquid savings?
Probably about $17K.
All right, I'd push
high yield money market.
I'd push it to about 35.
Yeah, I mean, something happens and suddenly you can't work for a year.
Yes, disability insurance as well.
Mm-hmm.
So do those. Continue the Roth IRA.
Does the traveling nurse?
I gotta imagine that they.
You're not traveling though, are you, with your family?
So I try not to travel very far. I stay within my state for the most part. I don't typically go cross country. So, and I only work 3 days a week, so I'm able to be home a lot.
Okay,
got it.
So
Got it. That's why you're doing it.
Okay, so do those things. Continue the Roth IRA, right? And that should be all equities, by the way, all equities. Then buy that life insurance. Look at a disability policy of some sort.
Hopefully your employer provides some.
Hopefully.
I would check that.
And then get $35,000 actually in that high yield savings account. Just go online and use a high yield savings account. When you do that, call us back.
All right. That sounds good. I will do that, guys.
Okay.
And by the way, Adam,
Thanks
you're
so
doing
much
great.
for the
I mean,
advice.
unless you got $120,000 of consumer debt that you haven't told us about.
I assume you don't have a lot of
No.
consumer debt?
No, just my house for the most part.
Perfect.
And how long ago did you buy your house?
I think we're going about 3 years now. So we got a pretty good interest rate. Got a pretty good price on it. We definitely bought at the right time.
Okay. And
Which
by the
I'm
way,
thankful for.
Dave, I'm a fan of a lot of what Dave Ramsey says, but the idea that he wants people to pay down their homes super quick,
Yeah, I don't agree with that.
I don't agree with that.
Particularly people that are financially responsible.
Correct.
Like you.
So don't make any extra payments on your home.
Uh-huh.
Make the minimum
gotcha.
payment on your home. Once you get all that insurance done and the $35,000, call us back and we'll walk you through the next step.
All right, we'll do, guys.
I
Thank you so
appreciate it.
much for the help.
And congrats on the baby, the new baby.
Thank you.
Yeah, that's
Thank
pretty
you.
awesome.
Yeah.
But I tell you what, it is always a challenge when like looking at life insurance. And I'll never forget years ago, a woman was referred, it was a friend of mine. Hey, a good friend's dying of cancer. Would you mind meeting with his wife? I'm trying to think if I met with her before he passed. Maybe it was right after he passed. He had just passed. And I think there was maybe $600,000, $700,000 of life insurance proceeds. She hadn't worked outside of the house for a number of years.
Oh. Couple kids at home?
Yeah. Oh, yeah. And the reason I'm telling you the story is she had talked to some other advisor. This was in the 90s before the dot-com. Talked to some other advisor about how she's going to be fine and here's how much money she can expect each month. And then she met with me. And my answer was, you're going to have to go back to work. You're going to have to figure out a career again for yourself. You cannot afford to stay home. She didn't like my advice, and I don't know what ended up
She
happening.
used the other
I
advisor.
guess she used the other one, and then she went back to work anyway because
because it was in the
totally-
90s. It was in the 90s. I remember advisors saying, "No, you could expect 15% returns." I'm like, "What?"
yeah, short-term bias, right?
Yes,
Like whatever happened recently, we're going to assume that's going to continue forever.
forever.
Yeah,
And look at the
and
spreadsheet.
that's why I look great. That's why we're big believers in having some term life insurance when you've got kids at home.
Yeah, which you've seen it. So, talking about short-term bias, I had mentioned earlier in the show, we were going to talk about Cathie Wood's ARK fund. And ARK,
ARK.
It
was. I think she was the first, or if not the first, but one of the first actively managed ETFs, exchange traded funds, which are very similar to mutual funds, but slightly different.
Yes, they just price throughout the day essentially, and you can actually use derivatives on them as well. But otherwise, they look like mutual funds. So big holdings of Tesla, Zoom, Roku, the things that have been on fire. And what's interesting is this article came out and said there has been a great outflow of money from her ARK funds.
Well, at its peak, Pat, in early 2021, $59 billion were in the funds, and today it's $11 billion.
Right. But what was interesting is as this one fund that they started with, their ETF was doing well, they started rolling out other ones. Right? And this reminded me of the Janus funds in the 1990s.
Well, it's like, think about any business.
Right.
You've got some product. You've got these loyal customers, love your product. You're like, can I have another product that they might be of interest to them?
And then you create another
I've been
Beanie
selling
Baby.
suits, but maybe they want a tie as well.
Or we've got the Princess Diana Beanie Baby. Let's get the giraffe, right? So it's brand extension is all it is. It's it's brand extension.
Right.
They're taking the
of it as a
brand
business.
and they're trying to sell you more.
Yes.
And if they have different names, then maybe you'll feel that you're getting something different. But unfortunately, most of the ARC funds held very, very similar. There wasn't a different thesis behind the investment for each one of the ARC funds. So people would buy 2, 3
Well, it was still
different types.
it was based upon Cathie Woods, who she was like for a brief moment of time, I guess some sort of investment guru on momentum stocks and why valuations don't really matter because it's or something. I never quite
and
understood her philosophy on investment.
Even saying that in 5 years Tesla should be worth $2,000 a share, which is just mind-boggling. As of the printing of this particular article, it was down 40% for the year. But what made me think about this is what we've talked about time and time again, Scott. Well, first of all, I talked to Scott before we got on the show today, and I said, did you see this article? And he said, yes. I said, does this remind you of a couple things? One, it reminded me of the Janus funds in the 90s because they rolled out all these different funds that were tech funds. And Janus was an old – I don't know if they're around anymore.
Yeah, Janice Henderson.
Janice Henderson.
Only reason I know is because I was in Denver walking down the street and I saw the sign on the building.
Oh, in Cherry Creek.
Was it in Cherry Creek?
Yeah, in Cherry Creek. That's right. But Janice was actually.
We both have kids in Denver. That's why we know who Cherry Creek
correct.
is.
I have a son that lives in Denver.
And my daughter lives in Denver.
So it reminded me of Janus funds, which, by the way, Janus funds actually started as a vision of Standard Pacific Railroad, just if you want to ask where it started. But when they were doing really well in the 90s, because it was all tech, they just rolled out more and more funds. The other thing it reminded me is, and we've talked about this on the air, which is returns to investors, not returns to funds. Because funds will actually tell you how the fund did. What we want to know is, how did the investor do? Not how did the fund do? How did the investor do?
And here's why and you're like, what is the difference? The difference is, like, for example, a spokesman for ARC's value creation said it was evidenced by the flagships fund 109% return since its inception in 2014, which isn't that great, by the way. 10 years, 7% annualized return. I don't know exactly what the S&P did. But
it isn't mind.
You certainly weren't compensated for the risk. But people started throwing money in not when it was down, but when it suddenly became hot.
They bought
my guess
near the top.
The return had already the 109% return was probably already had taken place before the average investor actually bought the fund.
Before they hyped the heck out of it. Before the ARC funds hyped the heck out of it. And Cathie Wood was all over all the financial, talking heads on TV and in the Wall Street Journal. So it reminded me.
And if you did the analysis, my bet is that more people lost money. Well, I don't have no analysis needed for that. More people lost money in her fund. The question is, was there actually a degradation of value?
As more money went in?
I bet that on a net, she's lost money.
The average investor.
Yeah, because all this looks at is you put $1 in at the start.
At the beginning.
At the beginning, what's $1 worth today? But maybe it had $1 for a few years, and then suddenly there was $1 billion thrown in, and then we fell back to $2.
And we know that people actually, from peaking at $59 billion in early 2021, is now $11 billion in they're managing. So that tells us that people put money in when it was popular and took money out when it was bad. And by the way, we're not saying that it's either a good or bad fund. She's doing what she does. She's doing what she does.
We never recommended for any of our clients.
We haven't, but but I'm not saying she's doing what she's done. She does, which is she picks high risk momentum type stocks. And she has the returns that say, I pick high risk momentum type stocks.
This article in the journal, it highlighted a couple people. I'm always curious to the people who would say, oh, yeah, you go ahead and print my story. So, here's a 63-year-old accountant
Who recently sold at steep losses.
But here's another one. It's I'm now down about 50 to 60% in all my accounts. I'm not sure how to move on 3 years later.
Right? So,
and the point is, I think we're not bringing this up to pick on Cathie Woods.
It's the investor.
Completely agree.
It's the investor. The investor got enamored with the story and ignored the risk.
Yeah, and maybe went onto Reddit and started listening to
whatever hype there was out there. Ignored the risk, right? What's going well will always do well. What's going poorly will always do poorly. None of that's true. This shall pass. The good times will pass. The bad times will pass. The good investor stays invested in a portfolio that is designed for a reason. The portfolios are designed to satisfy your need, right? Look, if I want income, or do I want growth, or do I want growth and income?
And it's looking at that need, and then it is building the most risk efficient, minimize risk as much as possible, having the highest probability for success.
And tax efficient. Risk efficient and tax efficient.
Combined, at the same time.
Yes.
And something like this fund is not, highly risky.
Highly risky.
But you read I read these accounts from people, and I have no empathy or sympathy for them. I don't.
A little. Just a little.
All right,
just give me a little.
I probably feel more sorry for someone who'd never saved a dime their whole life, lived recklessly, and is poor at their old age, than someone who.
Okay, well, I'm not going to go there.
I don't
with you.
know.
All right.
I feel bad for anyone who's financial. We've all made financial mistakes.
I feel bad for the Uber driver that's telling me about Bitcoin. I feel bad for them. All
right, I do too. Fair point.
Right? They buy the hype. Look, you buy the hype. ARC funds. Let's just create more of them. We could sell more of the stuff to the same people.
And this ship sailed, right? So it's done. No one's going to be talking about this fund or her 5 years.
We might be the very last people to talk about it.
But there will be something else. There will be another Cathie Woods. There'll be another ARC fund where people want to. It's doing great. You got to get in on this. You kidding me? The thing went up 72%. I don't know what it went up, but I'm just saying it. It's up 72%, and it's just starting because look at what they're doing and all this stuff. Next year's going to be even better.
Yes.
And you could retire younger and earlier than you're planning and all that stuff. So
it very. Hey,
let's go back to calls here, Pat, because we got some calls here. We're talking to Roz. Roz, you're with Allworth's Money Matters.
Hi. Good afternoon.
Hi, Roz.
I am 63 years old. I am still working. And I have a pension, and I have a, obviously, Social Security. I don't have tons of money, but I feel like I'll be comfortable. But what I'm asking about, and I know it's not necessarily something you can answer directly, but just kind of a rule of thumb. When is it what's a good way to determine when it's time to retire, other than that you're tired of working?
I can answer.
Should I pull that trigger?
Oh, yeah, I can answer. Not even a rule of thumb. We can answer directly if you've got a couple minutes to go through some numbers.
Sure.
Well, you mean I'm confused on the question or what your response is, because there's two factors at play. One is, do we have the financial resources? And for some people that never comes. And for some people, that comes way before normal retirement age. And then the other second thing is, are we at a stage in life where we want to leave this career to do nothing or to move on to something else, right?
But yes, either which way we can answer that.
Okay.
Right? So let's just go through the economics of it, the finances of it.
Okay.
How much do you make now?
All right. I make about gross about $108,000 a year.
And How much are you putting in your 401k as a percentage of your pay
Or dollar amount?
or dollar
Well,
amount?
just this month I maxed it out at I think about 33,000 or something like that. I increased the amount. I think I was doing 24 before that.
Okay, we're going to go with 24,000. All right.
All right.
Is that 9,000? And what will your monthly pension be?
7,000 gross.
And how much money do you have saved in your 401k or IRAs?
It's a nice pension.
My 401, and this is from memory, I think it's about 300,000.
Okay.
I have a really tiny Roth IRA, which is just like 26,000.
And money in the bank?
Money that's earmarked for some other things, so not a lot.
Do you own a home?
Yes,
And is it
but
paid?
no, it's not paid for. I have like 250,000 on a mortgage right now.
Well, Raj, your pension income is going to be more than what your take-home pay is now.
That's right.
It's actually, if you take 108,000 and 24,000 what you had been saving, subtract that, that's 84 grand,
And then you
which is what your pension is.
but so when you take what you're paying into Social Security
Because
and
you won't
the-
have to pay that once you retire.
and disability benefits and all those other little things in there, it's about 9,000. You can retire comfortably on that $7,000 a month pension.
Your pension will be worth more than what you're currently taking home without Social
Oh.
Security.
Okay,
Without Social Security. Are you eligible for Social Security?
Yeah.
I am, and I have either mine or I could take my late husband's until mine grew more.
That's right. That's the way you want to go. The latter. And when I asked about the mortgage, you were going to throw in a but there. I kind of heard something. Do you plan on moving or?
No. My hesitation was the money I have in the bank right now is from a refinance to, upgrade the house.
To do upgrades on your existing house or to sell the house and
Yes.
do upgrades. Okay.
Yeah.
Yep. You can retire comfortably.
Yeah.
Okay.
Yeah.
Yeah.
right.
So at this
That
point,
sounds
you're
great.
working because you want to, not because you have to.
Comfortably. That's without even touching your 401k or your Social Security.
Your first check in retirement is going to be worth more than your take home is now. And a pension that's guaranteed the rest of your life, based upon the information you told us.
Nice. Thank you.
Yeah.
All right.
Well,
That sounds great.
We didn't do anything. We just answered the question. I wasn't the one that worked.
yeah. For an organization that had a nice pension.
It has a nice pension. I assume that you work for a utility or a government.
Exactly.
There we go. There we go. Yep. You're comfortable. You're comfortable. And when you mentioned you took some money out on the mortgage, is that a recent refinance? Was it a full refinance or a partial finance or?
It was in 2020. It was a full.
Beautiful. Interest rates somewhere around 3%.
3.25%.
There you go.
Great.
Perfect. Enjoy.
Yeah.
Retire. Go back and leave nicely.
Yeah, appreciate the call, Ron.
Yeah. Congrats.
And we're continuing in Ohio, talking to Ellen. Hi, Ellen. You're with Allworth Money Matters.
Specific question about when you would recommend a person looking at annuities. So I am 64. I'll be 65 in March. My plan had been to stop working when I turned 65. That may or may not happen, but I'll at least go down in hours. So I will be not working as much when I turn 65 at least. Okay. And right after the first of the year, I'm going to be getting approximately 2 years worth of income from a deferred comp plan from my company. And taking that money is what I'm wondering, would it be a good idea to put into an annuity? I haven't thought about annuities for 15 years or so, and I had heard at that time huge fees that the brokers would receive. And so I said, no, never going to be interested, put it to my back of my mind. And now that I have this specific circumstance coming up, I'm wondering, and I've heard that annuities have kind of changed over time, and maybe it's not the huge fees anymore, and maybe it is something that I should be considering.
What is it you're hoping an annuity would provide for you?
Stability of inflow. I'm a very conservative person. I think I have fine enough money and everything. I'm a good saver. You will definitely say that when you hear.
Okay.
But I'm also very conservative, old-fashioned, just want to have that security of knowing that there's money coming in.
What do you have? What do you have in savings? 401k, IRA. What do you like? What have you saved up?
In my retirement account, I have about $1.5 million.
And how's that invested?
Primarily, that would probably be at this point in time about 75% in mutual funds. There's a reason, because when you need to know, I have about $900,000 in cash and cash equivalents right now. That number's gone up a lot recently. I haven't had that much money in cash, but I have a lot of cash, so I've been starting to put my retirement that shouldn't I have to touch for quite some time. I've put more of that into mutual funds.
And you said recently that all of a sudden there's a lot more money in cash. What has happened recently that has caused a spike in your cash holdings?
Two things primarily. Part owner in a company for a couple of years now, and I moved from Colorado. Cost of living and housing prices a lot higher it is there than it is in rural Ohio, where I currently am.
Okay.
So I got a lot of money out of real estate.
And do you own your primary residence now?
Yes.
And how much money do you think you're going to need to live on?
I'm cheap and conservative. I could live on very little, but $50,000 a year, $60,000 a year.
And what's
that'd
your
be fine.
What's your health like relative to other 64-year-old women?
It's decent. It's average. I'd say I have longevity in my family side for females, so that I've got good genes. If I could just be a little more active and lose some weight, I'd probably be healthier. But it's probably average, I'd say.
And single?
Yes.
You might be a good candidate for an immediate annuity.
Yeah.
In this market. Like a year ago, I mean, rates have been so low for a while. I was just like, it's not a very good time to lock your money in for the rest of your life. But
how much after-tax dollars will come out in 2024?
For the deferred comp or in total?
No, this is, you were talking about a non-qualified deferred compensation plan, I assume.
Yeah.
That's going to spring at the time that you lower your, right? How much money will come out?
About after-tax $250.
Yeah, it wouldn't bother me. I could see that.
An immediate annuity.
An immediate annuity. Yeah.
Which means what exactly?
You give up, so there's pluses and minuses. You give up control of that dollar in return. It's like buying a monthly pension.
Mm-hmm.
It's like you went to work. It's like this. It's like taking this non-qualified deferred compensation and converting it to a monthly pension.
Okay.
And a year ago, the rates wouldn't have been attractive. They're much more attractive today.
Okay.
You're only doing it to make yourself feel good, though.
Yeah.
Yeah.
That's the only reason you're doing it.
Don't buy an equity index annuity, or you don't need a variable
you don't need to do this. I mean, look, we could take that $250,000. You could drop it on top of the cash that you have. Now you're at $1.15 million. We add it up. It's all $2.65 million. What was your income last year?
Well, my wage is $175, but my taxable adjusted gross income is just under $500.
Okay. Yeah, you're doing it to make yourself feel good.
Okay.
Look. I could make an argument.
You can be really conservative in parts of your portfolio.
That's right.
Which is, you might want to do either kind of you don't want to be 100% conservative in everything.
But by the way, you kind of got it backwards a little bit here too.
What's backwards?
She's got all the equities in her retirement plan, and you've got all your taxable stuff outside, and it should be actually the opposite. And the reason is that income that's being derived from your cash. Let's say we put a conservative bond portfolio, average length, medium length bond, intermediate length bond portfolio in there. That's going to be taxed as ordinary income as it comes off, versus if you had reversed it and put that in your IRA and the equities tax managed outside, they're going to receive not only a step up in basis at death, but you're going to have capital gains when you go to sell them.
And very little in the way of taxable distributions.
And very, very little bit on the...
And they're qualified dividends, that even the ones that are. So
yeah, so you've kind of got it backwards. Well, not kind of. You got it backwards.
Okay.
And so, quite frankly, have you ever used a qualified advisor before?
No.
You
just have a couple conversations.
Yeah. Go pay them for a financial plan, and
have a couple conversations.
That's
Find
right.
someone you like and trust.
I mean, I've known you for what? How long have we gone here? 4 minutes? 5 minutes, maybe. Right. And you look at it and you're like, oh, great saver. You said you were a good saver. I like the fact that you actually asked about the annuity. Yeah, I could argue for or against it. Economically, it's not going to make a bit of difference. I don't think if you were my sister, I'd say, nah, don't bother. But your portfolio needs to be tweaked.
If your portfolio was much smaller, it actually might be a larger opportunity to use it.
Oh, there's no question. Yeah. There's no question. So if you look at how much of your
if you didn't have any buffer, but you've got a lot of buffer.
Yeah, and then your income, you need $50,000 a year to live on. Your Social Security is going to provide 35 of that, right?
Yep.
Yeah, I mean, I think that you should actually take more income than $50,000 out to live on. I think you should live it up a little bit. Buy yourself whatever you guys buy in Ohio. What is it? Corn? What is it? Chili? You guys eat chili with spaghetti on?
What is that weird chili they have in Ohio?
Skyline chili.
Is that what they call it?
Yeah, Skyline, yes.
Yeah,
get yourself some extra Skyline. But that's going to be contrary to things she says she's trying to lose some weight. Yeah.
You get them on the spaghetti noodles, and then they put the cheese.
I don't know why they call it chili.
I don't know either.
I love local traditions, I must say.
Yes, but not that one.
Oh, come on.
Anyway, all right. Good luck to you. Pay an advisor to just or have a couple conversations with one.
Wish you well,
all right.
Alan.
Thanks.
Thank you very much.
And we're in California talking with Tony. Tony, you're with Allworth's Money Matters.
Yeah, how's it going?
Good.
I just had a quick question for you.
Yes, sir.
So my grandfather passed away about a year and a half ago, and he had everything in a family trust. And the only one on the family trust was my father. So my father was planning on, so he says, gifting this one account that he has to me and my brother.
Okay.
Splitting it in half. But we were kind of wondering how we go about that and not get hit with a bunch of taxes.
Well, unless it's an IRA or an annuity.
You won't have any taxes.
Or savings bonds.
The only taxes you would have would be whatever the change in value. Actually, whatever the change in value of the stocks were or the portfolio from the date your dad inherited, assuming it was in a revocable trust when he received it.
Well, because it was in a trust, and then there's
different kinds of trust. So odds are it was in a revocable trust, a living trust. There's a chance it was in some sort of bypass trust that would not receive a step-up basis, but high probability it was in a typical trust that your father received it from a tax basis. It was all those securities were stepped up to the fair market value. So any tax you would have due would be a gain or loss from the date your dad inherited those assets.
Because it's not even, I think now we finally have it in my dad's name
Okay.
because it's taken about a year. I mean, we kind of didn't do
Yeah.
anything for about a year, and then the last 6 months we've kind of been working on it. So we were trying to transfer the account from my grandfather straight into my name.
Yeah,
and
that
my
wouldn't
brother's
work.
name.
That wouldn't work.
They wouldn't do that.
No, they
Because
wouldn't do
it had
that.
to go
That's
to
right.
my dad's
That's
name
right.
first.
That's right. And where does your dad keep the money? Is it like Fidelity or Charles Schwab or?
It's an Ameriprise.
Okay, easy enough. So just you and your brother go open Ameriprise accounts.
Yeah, we already have Ameriprise accounts.
And then just
What's the problem?
Your dad just signs transfer paperwork to transfer the money 50-50 into you and your brother's name. Easy. Take a day.
That's what we were hoping, but then
Just-
people are saying, "Oh, there might be a big tax."
How much
hit
is
or
it?
something." It's about 800,000.
And is it in an IRA?
No, I mean, I think most of it is stocks.
And is your
understand.
dad's estate worth more than $6 or $7 million?
No.
Yeah, then there's nothing to worry about.
Yeah. Just write this down. If it's in an IRA, an annuity, or in savings bonds, you have to worry about taxes. If it's not, easy.
You don't have to worry about it. In California, there's no sort of there's no federal tax that you have to pay, nor is there any state tax.
Yeah. The only taxes that you will owe is if you sell any of those securities, if there's capital gains from the date that your father inherited till the date he gifted you, you would be responsible for that. And that would be what's called a change in your cost basis. So, nope. So just remember, if it's an IRA, it's an annuity, or it's savings bonds, you need to take steps, or you will have to pay taxes.
But if
And
it's not, there's not.
and frankly, and it wouldn't even be you that had to pay the taxes; it'd be your dad. So, thanks, Dad.
Yes.
All right, appreciate the call.
Well, Pat, I know we had made some mention of discussing
This
the Department of
fiduciary.
Yeah, let's. I say we talk about it on our next week.
Yeah, let's talk about it
'cause
next
it's so
week.
exciting.
It is. Oh, and by the way, a couple of weeks ago, I mentioned an app that I was going to talk about.
Oh, you never did.
and I never did. And I got an email that said, "Hey,
What's the app?
it's called Libby, Libby. You need to get a library card to get it. Hundreds, if not thousands, of magazines, newspapers, and books, completely free. You check them out. I'm reading a brand new John Grisham book. I went on there and said, I would like this. And they said, when it gets returned, we will let you know.
Returned? There's a finite number of digital subscriptions.
Yes. And then it lets me read the John
You need
Grisham
a
book.
library card?
You need to have a library card, and you go get your library card. You go on the app. It's like you're going to a digital library. Magazines, free.
Is it a for-profit company, this Libby?
I have no idea. I was reading
You don't
Vanity Fair the other day.
Of course you were.
It's got some great articles in it.
The title itself sounds a little odd. So, anyway, it's been great being here with you. We will see you next week. This has been Scott Hansen and Pat McLean of Allworth's Money Matters. And Pietro, I'm going to add on a little Philip. Right? The one for the radio.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.